This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional. Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 21 April 2026.
Thank you for having me. I'm looking forward to our discussion today.
So let us set the stage here. Suppose you are a sponsor sitting in New York or London, and you have capital ready to deploy across the European Union. You know your commercial strategy inside and out, but well, you are facing a bit of a structural dilemma.
Right, the classic structuring challenge.
Exactly. You need the bespoke, highly adaptable freedom of a traditional partnership, to govern exactly how you distribute returns and manage commitments. But at the same time, you need the absolute certainty, the global recognition, and the clinical operational security of an established European regulatory framework.
It is a delicate balance to strike.
It really is. Usually that feels like choosing between a bespoke suit and a suit of armor. But today's deep dive is about how Luxembourg engineered a vehicle that gives you exactly both. We are going to conduct an elegant and highly detailed examination of the Luxembourg Société en Constitute Spéciale, which you will almost always hear referred to as the SCSP. Okay, let's unpack this.
It is a brilliant starting point. The Luxembourg framework is fundamentally constructive, It is not designed to restrict capital arbitrarily. Rather, it provides a highly stable, completely legible architecture for global asset management.
Right.
The regulatory authority, the CSSF, alongside the legislative framework, work in tandem to offer you structural certainty. When you decide to utilize the SCSP, you are picking up a precise, pragmatic tool.
I have a formidable stack of official sources right here in the studio, ranging from the foundational law of 10 August 1915 on commercial companies, all the way through to the latest CSSF circulars on liquidity management.
There is a lot of ground to cover in those texts.
There really is. Our mission for this deep dive is to extract the most critical insights from these texts. We are going to carefully unpack the core legal architecture of the SCSP, examine the practical implications for you as a sponsor, and map out its strategic utility within Luxembourg's regulated fund ecosystem.
That sounds like a solid roadmap.
So we need to start with the baseline definitions before we can run into the complex operational timelines. We are talking about a special limited partnership, one that is expressly recognized by Luxembourg law. But to really grasp how this operates for you in practice, could you lay out the three absolute must-know facts about the SCSP based strictly on the official texts?
Certainly. The very first must-know fact goes straight to the structural identity of the vehicle itself. An SCSP does not constitute a legal person distinct from its partners.
Wait, let me stop you right there. I want to make sure I understand the absolute foundation of this. If I form a traditional public limited company, I am creating a distinct legal person, right? One that can sign contracts, hold assets, be sued.
Yes, exactly. That is the standard corporate model.
So, if the SCSP does not exist as a separate legal person, how on earth does it operate in the real world? What is holding this entire structure together?
That is the pivotal question. Because it lacks a separate corporate veil, it is built entirely around a contractual nexus. You have at least one general partner and, at least one limited partner. The entity is essentially the highly codified agreement between them.
I see. So the contract itself is the framework.
Precisely. The general partner manages the partnership and assumes unlimited liability, while the limited partner's liability is strictly capped at their commitment.
Right. So if we use an analogy to make this concrete, a traditional corporate structure is like a locked steel safe. It has its own boundaries, its own walls, and it holds the assets. But an SCFT is more like a highly detailed joint bank account, where the exact rules of access, the distribution of funds, and the governance are completely dictated by an incredibly complex binding agreement between the parties.
That is an illuminating way to conceptualize it. It is entirely driven by that agreement. And what is truly remarkable here is how the Luxembourg company law framework pairs that lack of separate legal personality with extraordinary flexibility in how you, as a partner, can contribute to the vehicle.
Contributions, meaning how you actually fund your piece of the partnership.
Yes. Contributions can be made in cash, which is the standard expectation, obviously, but they can also be made in kind or even in industry.
In industry? Wait, are you telling me I can technically buy into a multi-million euro partnership using just my sheer expertise or my consulting hours?
Conceptually, yes. The law permits you to contribute your actual services, your ongoing work, or your specific expertise to the partnership, rather than just wiring capital or transferring physical assets.
That sounds incredibly flexible, but also, well, potentially complicated. How do you value expertise when it comes time to calculate voting rights or distribute profits?
That brings us right back to your analogy of the highly detailed agreement. Because the flexibility is so vast, the discipline required in drafting your partnership agreement is immense.
So you have to spell all of that out explicitly.
You do. The agreement must precisely stipulate how that contribution in industry is valued, how it translates into partnership interests, and, crucially, what happens if the partner fails to deliver those services.
Oh, right. What if they just stop working?
Exactly. The combination of contractual freedom and contribution flexibility allows the economic bargain between founders and investors to be documented exactly as envisioned, but it demands absolute drafting precision.
Which perfectly sets up the second must-know fact. Because setting up an incredibly flexible SCSP doesn't suddenly mean you are running a regulated alternative investment fund, does it?
No, it does not. And that is the second critical takeaway. An SCSP is not automatically a regulated fund just because it exists. It only transitions into an alternative investment fund or an AIF if it meets a very specific functional test under the law.
So the regulation looks at how the vehicle behaves rather than just reading the label on the door.
Exactly. What is fascinating here is the functional approach of the regulation. To meet the AIF test, the SCSP must satisfy 3 specific criteria.
Okay, let's go through those carefully. What is the first one?
First, it must be a collective investment undertaking that raises capital from a number of investors.
Right, so you cannot just be a single investor holding company.
Correct. Second, it must invest that capital in accordance with a defined investment policy for the benefit of those investors.
Okay, so you need a written strategy. And the third?
Third, it must not require authorization pursuant to Article 5 of the UCIT's directive.
Let us break that down for the listener. The first 2 parts make intuitive sense. You are pooling money from multiple people, and you have a written strategy on how you will invest it. But unpack that third prong for me. What does sitting outside the UCI framework actually mean in practical terms?
The UCIT's directive, which is Directive 2009-65-EC, is the European framework specifically designed for highly liquid, broadly distributed retail funds.
Think of your standard mutual funds investing in transferable securities, right?
Precisely. The AIF test effectively says, if you are pooling capital and following a strategy, but you are operating outside of that highly regulated retail UCIT space, you are operating an alternative investment fund.
And once you cross that threshold, once your SCSP meets that functional test, what are the immediate consequences for you as a sponsor?
The consequence is absolute and universal. Once that test is met, the Alternative Investment Fund Managers Framework, the AIFM framework, applies.
Just automatically?
Yes, it applies irrespective of whether your fund is open-ended or closed-ended, and crucially, it applies whatever your legal form happens to be. The regulation attaches to your function. You cannot use the partnership structure to arbitrage your way out of the regulatory perimeter.
That is a brilliant piece of regulatory engineering. It allows you to use the bespoke SCSP structure for your commercial needs, but ensures that if you are acting like a fund, you are governed like a fund.
That is the exact philosophy behind it.
Which brings us to the third must-know fact. How does the SCSP actually fit into the broader Luxembourg toolkit?
The third fact is about ecosystem integration. The SCSP does not sit in isolation. It is deeply embedded into Luxembourg's alternative fund architecture. Official product laws deliberately and expressly accommodate the SCSP.
When you say product laws, you were referring to specific regulatory wrappers that sponsors can utilize, right?
Correct. The 2 most prominent examples are the Reserved Alternative Investment Fund regime, which we know as the RAIF, and the Specialized Investment Fund regime known as the CEF.
Ah, the RAIF and the CEF.
Yes. Both of these frameworks explicitly allow you to use the SCSP as the underlying corporate form.
So, synthesizing these 3 takeaways for you, the listener, the SCSP effectively bridges 2 worlds. On one side, you have the bespoke, almost limitless contractual freedom of a partnership where you can dictate terms down to the finest detail.
Spot on.
And on the other side, you have the established certainty and the global credibility of Luxembourg's regulatory frameworks like the RAI or the SEC-EF. You do not have to compromise. You can harmonize the flexible contract with the credible regulatory wrapper.
That is a precise summary. Because the AIFM framework is legal form neutral, you gain the operational agility of a partnership without losing the robust compliance architecture that institutional investors demand.
All right, now that we have established what the SCSP is and how it functions conceptually, we need to transition into the structural mechanics. Yeah. To effectively utilize this vehicle, you need a highly practical blueprint.
You absolutely do.
I want to run through what I call the 5 W's and 1 H briefing. The who, what, where, when, why, and how of the SCSP. Let us start with the who. If I am looking at a whiteboard mapping out my new fund structure, who are the immediate actors in the room?
At the purest, most immediate level, the actors are dictated by the partnership itself. You have your general partner. As we discussed, they typically bear unlimited liability and hold management power.
Right.
You have your limited partners whose liability is confined to their agreed commitments. And you have the managers designated under the partnership agreement.
But the reality for most sponsors is that they're not just setting up a bare partnership, are they? They're setting up a regulated AIF. How does that perimeter expand constructively when we apply one of those product law overlays you mentioned?
It expands significantly to build a network of operational checks and balances. Let us assume you place your SCSP within the RAIF framework.
Okay, the RAIF overlay.
The RAIF law stipulates that every RAIF must be managed by an external AIFM. It further mandates that the fund's assets must be entrusted to a depositary appointed under the AIFM law. So your immediate cast of characters has now grown.
So our who list now includes the partners, the external AIFM, and the depositary. Can you explain the practical reality of that depositary for a moment? Because for sponsors coming from outside Europe, the depositary function often feels like an entirely new concept.
It is a critical function. The depositary is not just a passive vault holding the assets. Under the AIFM law, they have an active, ongoing duty to verify the ownership of the fund's assets, monitor the fund's cash flows clinically, and, ensure that the sale, issue, repurchase, and cancellation of partnership interests comply with both national law and your partnership agreement.
Wow, so they are actively monitoring the compliance of your transactions.
Yes, they are a structural safeguard for the investors.
That makes the who incredibly robust, which moves us to the what. In plain terms, what is the actual substance of this vehicle? If it doesn't have a separate legal personality, where does the commercial reality actually live and breathe?
The commercial reality lives entirely within the text of the partnership agreement. It is completely contract-driven. That document is the central operating engine of the entire structure.
It sounds like drafting that agreement requires surgical precision. What specific mechanics must that document carry?
It carries everything that defines your fund. It dictates the rules for capital commitments and how drawdowns are executed. It establishes the exact schedules and waterfall models for distributions.
So the entire economic model is baked in there.
Exactly. It also governs the valuation rules, the transfer mechanics for partnership interests, and the specific economic allocations between the general partner and the limited partners. Because there is no default corporate statute overriding these commercial terms, your drafting must be flawless. If it is not in the agreement, it does not exist.
That is a stark operational reality. Now, let us consider the where. The SCSP is strictly a Luxembourg legal form created under Luxembourg company law. Does that geographic origin limit its utility for a sponsor?
In what sense?
Say you are a sponsor aiming to raise capital across France, Germany, and the Netherlands.
Yeah.
Are you constrained because your partnership is rooted in Luxembourg domestic law?
That is a very common concern, but understanding the interplay between Luxembourg company law and the European regulatory framework completely resolves it. The SCSP is a Luxembourg form, yes, but its regulatory reach is expansive.
How so?
Because the AIFM regime applies by reference to function rather than label, the geographic utility is vast.
Because the AIFM law defines your vehicle by what it does, not the jurisdiction of its foundational contract.
Exactly. A properly classified Luxembourg SCSP integrates seamlessly into European Union passporting strategies. The legal form does not track your fund in Luxembourg. Rather, the AIFM passporting framework elevates your SCSP, allowing you to market it seamlessly to professional investors across the entire European Union.
So it is fully passportable?
Yes. The key is simply ensuring that your classification and your compliance architecture are correctly established.
That is a brilliant advantage. Let us turn to the when. Timelines are where structural theory collides with the reality of launching a fund and closing investors. What does the strict timeline look like when establishing an SCSP?
I will map this out with clinical precision because missing these dates has real operational consequences. As of 21 April 2026, the key timing milestones derive not from the bare partnership form, but from the product law overlay you select.
Right, so let us look specifically at the RAIF regime, which dictates strictly 3 sequential timing steps.
Yes.
Let us walk through those 3 embedded deadlines. Imagine you are a sponsor trying to coordinate your launch. What is step 1?
Step 1 occurs at inception. The constitution of the RAIF must be recorded by notarial deed within 5 working days, unless the vehicle was formed directly by notarial deed from the outset.
5 working days. For listeners unfamiliar with the Luxembourg system, the notary plays a highly formalized role in corporate constitution here. Correct. It's not just a simple signature witness.
That is correct. The notary in Luxembourg is a public officer who ensures the legality and proper constitution of the act. Meeting that 5 working day deadline requires your legal counsel, your general partner, and the notary to be perfectly aligned.
Understood. What is the second step?
Step 2 relates to publicity. A notice must be filed with the trade and company's register for publication in the Recueil électronique des sociétés et associations, commonly known as RESA. This filing must occur within 15 working days.
15 working days for the RESA publication. And the final step in the RAIF sequence.
Step 3 requires the RAIF to be entered onto the relevant register held list within 20 working days. Those are the strict relative deadlines built into the RAIF wrapper.
But the sources indicate another vital layer of timing, one that relates to the manager rather than the fund vehicle itself. Could you explain the 10-day rule under Circular CSSF 25894?
Yes, that is an equally critical, separate timeline. Circular CSSF 25894 mandates that relevant information must be submitted to the CSSF no later than 10 working days after a Luxembourg investment fund manager starts managing a non-authorized fund.
How does the CSSF determine when management actually starts? That feels like a potential gray area that could easily trip up a sponsor.
The circular is designed to remove that ambiguity by identifying 3 specific trigger events. The investment fund manager is considered to take on the role at the latest on the earliest of 3 occurrences.
Okay, what is the first trigger?
First, the signature or effective date of the management agreement. Second, the date of establishment or formation of the fund in specific cases identified by the circular. And third, any other date on which general management responsibility has demonstrably been conferred.
So whichever of those 3 events happens, first starts the clock, and you have exactly 10 working days to transmit the required information to the CSSF.
Precisely. It requires sponsors to treat the commencement of management as a strictly defined regulatory event, not just a casual commercial handshake.
That brings us nicely to the why and the how. We have looked at the structure and the strict timelines. Why did Luxembourg deliberately design the system this way? What is the underlying policy logic?
The why is rooted in accommodation and constructive design. Luxembourg recognized that sophisticated global sponsors require partnership-based structuring. Instead of forcing every alternative investment strategy into a rigid corporate mold, they created the SCSP to offer broad contractual freedom.
Right.
But they paired it with the product laws and the AIFM framework so that this flexible vehicle can operate safely inside a globally recognized, heavily resourced ecosystem. It is an intentional design to meet institutional needs without compromising regulatory integrity.
And the how. How do you, as a sponsor listening to this right now, actually execute this logic?
Execution relies on answering 3 sequential questions perfectly. First, you must define the legal and regulatory classification.
Meaning deciding if it is an AIF or a SIF or a RAF.
Yes. Is this vehicle going to be a bare partnership, an unregulated AIF, a RAIF, or a SIF? Second, does the partnership agreement capture the intended commercial bargain flawlessly? And third, have the operational overlays been mapped and engaged correctly?
When you say operational overlays, you mean the service providers and the compliance architecture.
Exactly. You must secure the AIFM appointment, complete the depositary analysis, engage the administrator, map out the disclosure and publication steps, and establish the anti-money laundering controls. The SCSP form gives you immense agility, but you must engineer the compliance framework from day one.
That transition moving from the clean structural blueprint into the messy reality of the daily operational playbook is exactly where many sponsors face friction.
It is a common pain point.
If the partnership agreement carries all the commercial substance, as you explained, how does that translate into the actual suite of documents you present to investors?
It means the heavy lifting happens entirely during the drafting phase. Because the partnership agreement is your central engine, every single surrounding document must align with it flawlessly.
I imagine that is easier said than done.
It requires deep coordination. Your offering materials, your subscription documents, your delegation architecture, your valuation mechanics, they all must mirror the partnership agreement without the slightest contradiction.
Let us explore what happens if they do contradict. Imagine you spend weeks perfecting your partnership agreement, detailing a highly specific waterfall distribution. But your legal team drafts an offering memorandum that summarizes the valuation methodology slightly differently. What happens?
You have introduced a structural flaw from the outset. In an SCSP, ambiguity between the constitutive contract and the offering materials creates severe operational and legal risks.
So the whole system sort of jams up.
Yes. The depositary will flag the discrepancy, the administrator will struggle to execute capital calls correctly, and the investors will demand clarification. Alignment is not just best practice, it is operationally mandatory.
And our sources highlight that there are specific regulatory requirements for those offering documents, depending on the overlay you choose. For example, the RAF regime requires a very specific cover page statement. Why is that?
If you operate your SCSP under the RAF regime, the offering document must display a highly visible statement on its cover page, confirming that the RAI is not subject to supervision by a Luxembourg supervisory authority.
That sounds, well, alarming to an uninitiated investor. Not subject to supervision. Why does the law mandate that specific warning?
It is a critical piece of transparency that reflects the RAF's specific architecture. The RAF is designed for speed to market. It does not require ex-ante authorization from the CSSF before launch.
Right.
However, it achieves its regulatory safety because it must be managed by an authorized external AIFM. The supervision occurs at the manager level, not the product level. The cover page statement ensures absolute clarity for the professional investor regarding where the regulatory oversight resides.
That makes perfect sense. It is about transparency of the oversight mechanism. Now let us talk about a topic sponsors deeply care about: privacy and record keeping. The traditional appeal of a partnership is that it is often a private arrangement. How does the SCSP handle public visibility versus internal discipline?
The framework handles this with a very elegant balance. The public filing profile is designed to be relatively light. Under official Luxembourg company law procedures, acts of an SCSP are published only by extract.
So just the high-level details.
Yes. This contrasts sharply with corporate forms, where constitutive acts are often published in full.
So the outside world, searching the register, only sees a high-level extract. They do not see the bespoke commercial terms, the waterfall mechanics, or the specific partner commitments. But what is required internally?
Internally, the discipline must be absolute. Every SCSP must maintain a register containing, at a minimum, a full and true copy of the partnership agreement in its current up-to-date version.
So you cannot just have loose term sheets flying around?
No, absolutely not. The external visibility is minimal to protect commercial privacy, but the internal record-keeping burden is real, continuous, and exacting.
Let us pivot to a fascinating operational benefit highlighted in our sources, one that relates directly to the limited partners. The law states that a limited partner can enter into transactions with the SCSP without losing certain rights. Can you unpack how this works and why a sponsor would care?
This is a highly strategic mechanic for sophisticated fund structures. Under Luxembourg company law, a limited partner may enter into transactions with the SCSP without losing the benefit of its ordinary, unsecured, or privileged creditor ranking, and without losing the benefit of any guarantees or security interests.
Let us put that into a concrete scenario. Suppose you have a limited partner who has committed capital to the fund, but the fund suddenly needs short-term liquidity to close an acquisition before a capital call can be fully processed.
Very common bridge financing scenario.
Exactly. That limited partner agrees to step in and provide a bridge loan to the SCSP.
Are you saying they do not automatically get subordinated to all other external creditors just because they hold a partnership interest?
That is precisely what the law permits. They are treated like a regular creditor for the purpose of that specific transaction. They do not lose their creditor ranking merely because of their partner status.
That provides immense operational utility. It allows sponsors to use partner financing, bridge arrangements, or complex co-investment mechanics seamlessly.
It does. However, while the statutory framework permits it, executing it requires precise drafting in your partnership agreement. You must ensure the transaction respects the wider liability and governance framework, ensuring no conflicts of interest breach the established AIFM controls.
It all comes back to the meticulous drafting of the agreement. Now, earlier we discussed the 10 working day notification requirement under Circular CSSF 25894 when a manager begins operations. But how does that obligation evolve once the fund is actually running? I assume it is not just a file and forget situation. It absolutely is not. Circular CSSF 25894 imposes an ongoing operational reality. Yes, the Luxembourg Investment Fund manager must transmit information upon the commencement of management. But crucially, it also requires the IFM to notify the CSSF without delay of any substantial modification to the information or documentation previously communicated.
So the regulatory radar is continuous. If you change a core element of your strategy or a key service provider, you have an immediate obligation to update the authority.
Precisely. The CSSF maintains an accurate, real-time oversight of the non-authorized AIF landscape through this continuous notification requirement.
Let us address another practical operational question. When sponsors build these structures, they often want to leverage global teams or existing administrative hubs. What are the rules regarding the physical location of the fund's administration?
The CSSF has provided clear guidance on this through a dedicated FAQ to Circular CSSF 25894. The rules depend entirely on how you classified the vehicle on day one.
Let us take the RAIF scenario first. If your SCSP is operating under the RAIF regime, where must the administration sit?
For a non-authorized AIF established in Luxembourg, that is a RAF, the accepted location of the administration is strictly Luxembourg. The entity providing the administration must be authorized to provide UCI administration services to the relevant AIF under Luxembourg law.
So a RIF strictly requires a Luxembourg-based authorized administrator. What if the SCSP is classified as a non-authorized AIF, but you've chosen not to use the RAF wrapper?
In that scenario, the FAQ permits non-Luxembourg administration. However, the non-Luxembourg entity must be suitably authorized to provide UCI administration services to the AIF concerned under the applicable legal provisions. Again, your initial legal classification completely dictates your operational reality.
What about costs and tax impacts? Can a sponsor listening to this map out a standard fixed cost for operating an SCSP?
Clinically speaking, there is no generic answer that applies to every SCSP. Fixed public law costs depend on the exact regime you choose and the specific filing paths required.
And on the tax side?
As for tax impacts, our sources make it abundantly clear that the tax profile remains entirely structure-specific. It must be assessed by reference to your actual investment strategy, the domicile of your investor base, and the specific regulatory wrapper you deploy. The SCSP is inherently bespoke, and so is its tax analysis.
I want to zoom out for a moment and look at the broader context of the market. How does this highly specific vehicle operate against the backdrop of the broader Luxembourg ecosystem? Just to give you, the listener, a sense of the immense scale we are talking about. Official statistics from the CSSF as of 28 February 2026 report 3,005 collective investment undertakings, representing total net assets of 6,436.135 billion euros.
If we connect the SCSP to that bigger picture, that immense scale explains exactly why the vehicle is so prevalent. The SCSP does not exist in a vacuum. It is integrated into a mature, highly resourced financial ecosystem.
Right.
Sponsors do not just choose the SCSP for its standalone legal flexibility. They choose it because that flexibility is supported by thousands of experienced professionals, authorized depositaries, expert administrators, specialized legal counsel, and a sophisticated, constructive regulatory authority.
And that ecosystem is continuously evolving to meet modern market demands. I want to look at a very recent, highly relevant development detailed in our sources, stemming from the law of 3 March 2026. This law transposed AIFMD 2 and UCI 6 into Luxembourg legislation, and it touches directly on a critical operational area: liquidity management.
Yes, these are vital developments regarding liquidity management tools, or LMTs. Following the law of 3 March 2026, the CSSF announced a dedicated liquidity management tool e-desk procedure to systematize how managers report their liquidity controls.
And this procedure rolled out in very distinct phases over the last few weeks, correct? Let's walk through the exact timeline.
The e-desk procedure features specific modules. First, the LMT selection module was launched on 23 March 2026.
And what did that require?
This module required Luxembourg-authorized AIFMs managing open-ended AIFs to communicate their selected liquidity management tools, alongside detailed policies and procedures governing exactly how those tools would be activated and deactivated. The firm deadline for that detailed submission was set for 16 April 2026.
And then there was a subsequent module activated shortly after.
Yes. The CSSF confirmed that the LMT activation module was launched on 10 April 2026. Furthermore, Just a few days ago, on 15 April 2026, the CSSF published Circular CSSF 26910, which officially applies the ESMA guidelines on liquidity management tools for both UCITES and open-ended AIFs.
Let me clarify this for a sponsor who might be listening and worrying about their partnership agreement. Do these LMT developments change the foundational legal nature of the SCSP? Do you need to fundamentally restructure the entity?
No, they do not alter the company law nature of the SCSP at all. The partnership mechanics established under the law of 10 August 1915 remain completely untouched.
So the foundation is stable.
Exactly. However, if you are operating your SCSP as an open-ended AIF, these developments are immediately and operationally relevant to your manager. It demonstrates that the regulatory overlay evolves to ensure market stability, even while the structural foundation of your partnership remains steady.
That is an important distinction. The vehicle remains stable, but the operational expectations around liquidity evolve. That brings us to the broader supervisory priorities of the CSSF for the remainder of 2026. The official texts show a continued emphasis on governance, digital operational resilience, and liquidity risk, which we just saw practically applied with the LMT modules. But there is one specific element that our sources make clear is not just a passing priority.
You're referring to anti-money laundering and counter-terrorist financing controls.
Exactly. I think it is crucial to frame how a sponsor should view AML and CFT within this flexible structure.
It is a paramount framing constraint. The CSSF's continued focus on AML and CFT demonstrates that these are permanent structural pillars of the regulatory framework. They are never mere trends, and they are never temporary areas of focus.
That is a critical point to internalize.
It is. The overarching message for anyone utilizing the SCSP is clear. A highly flexible legal form demands exacting, flawless governance. Operational flexibility does not mean a relaxed compliance environment. In fact, because the SCSP relies so heavily on contractual freedom, it requires even sharper internal discipline to ensure that the regulatory mandates, particularly regarding AML, are executed perfectly.
We are recording this deep dive on 21 April 2026. Looking ahead to the horizon for the rest of the year, what specific dates or legislative shifts should you, as a sponsor, mark on your calendar regarding the SCSP?
Based strictly on the official text currently visible, there is a clear objective reality. As of 21 April 2026, there are no fixed future legislative dates specifically targeting the SCSP entity form itself in the reviewed official sources.
That is actually quite reassuring from a planning perspective. You aren't bracing for a sudden structural overhaul of the vehicle you just launched.
It is highly reassuring. The emphasis for sponsors and their legal counsel remains squarely on managing the embedded relative deadlines we have already explored in depth.
Right, the sequential rules.
Yes. You must manage the 5-working-day notarial deadline, the 15-working-day RESA publication notice, and the 20-working-day listing requirement for your RAIFs. And naturally, you must strictly monitor the 10-working-day management trigger for your notifications under Circular CSSF 25894.
And looking backward just briefly to confirm, the major fixed date of 16 April 2026 for the LMT selection reporting has successfully passed.
Yes, that is complete.
The CSSF has certainly signaled that they will conduct further supervisory work across 2026 regarding their core priorities, but there is no specific new date attached to an SCSP milestone. The regulatory approach in Luxembourg remains steady, scheduled, and transparent.
Exactly. The regulatory environment is designed to provide clarity without abrupt disruptions. This deliberate stability allows you to focus on your execution, your capital deployment, and your commercial strategy, rather than constantly anticipating unannounced legislative shifts.
That sets us up perfectly for our final section. Let us tie all of this structural theory, the timelines, the operational mandates, and the regulatory overlays together into a practical execution narrative. Walk us through a scenario of a sponsor achieving absolute mastery over the SCSP when entering the Luxembourg market today.
The execution narrative almost always begins with a standard, entirely correct commercial instinct. You desire a flexible partnership structure, you want to manage capital commitments efficiently, you want to schedule distributions according to complex bespoke waterfall models, and you want to avoid the administrative rigidity that comes with a traditional public limited company.
Right. You are looking for a vehicle that behaves with the agility of a premier private equity or venture capital fund.
Exactly. That is the goal.
But where does the execution usually go wrong? Where is the trap?
The critical error, the trap that delays launches, inflates legal costs, and frustrates investors, is the temptation to draft the commercial documents first and classify the vehicle later.
Putting the cart before the horse, essentially.
Precisely. A sponsor might spend weeks perfecting a partnership agreement, only to realize at the 11th hour that their commercial terms conflict with the required operational overlays of the AIFM framework, or the RAIF regime.
So, if drafting the agreement first is the mistake, what is the precise sequence for mastery? How do you engineer this correctly from day one?
The precise sequence begins with classification first. On day one, the decisive question must be answered. Is this SCSP going to operate as a bare partnership entirely outside the AIFMD perimeter? Is it an alternative investment fund? Is it going to be structured under the RAIF regime or perhaps the SUF regime?
Because that single decision acts as the master switch for everything else that follows.
Exactly. That single classification cascades into all subsequent operational requirements. It dictates whether an external AIFM is legally mandatory. It determines the scope of your depository needs. It outlines your disclosure rules, including whether you need that specific cover page warning we discussed.
It sets the whole machine in motion.
It does. It triggers the circular CSSF 25894 notification timelines, and it dictates whether your administration must physically sit in Luxembourg.
Once that classification is locked in correctly, how does the rest of the process unfold for the sponsor?
Once you classify correctly, you achieve alignment. Your general partner, your designated managers, your AIFM, your administrator, and your depositary are all operating from the exact same structural blueprint.
Everything is in sync.
Yes. Only then can your partnership agreement be drafted to hold the real commercial bargain with absolute precision, because you already know exactly where the regulatory boundaries lie.
It is about engineering your compliance around your commercial goal, rather than desperately retrofitting your commercial goal to survive a compliance check.
That is a perfect way to phrase it. When you align the structure from the outset, the SCSP functions as a highly credible, remarkably precise fund platform. Your transactions progress smoothly, your relative deadlines are easily met, and you can focus entirely on capital deployment rather than structural repair.
We have spent a lot of time today mapping out the intricacies of this vehicle, but I want to leave you, the listener, with a final thought to mull over as you look at your own fund structures. We discussed how the entire commercial reality of the SCSP lives within the text of the partnership agreement and how crucial precision drafting is. As the market evolves, as liquidity reporting tools become more systematized, as we saw with new eDesk modules, and as AI automation begins to accelerate these 5-day and 15-day filing windows, will the bespoke, handcrafted partnership agreement eventually transform into a standardized smart contract? Will the ultimate flexibility of the SCSP soon be executed through code rather than paper? It is a fascinating question regarding where this architectural flexibility meets future technology.
It is a compelling operational horizon, but fundamentally, Luxembourg is strategically relevant here because it allows partnership logic to operate within an established European Union funds framework without forcing every alternative strategy into a more rigid company law mold.
Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigore Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.